All right, boys, it is day 3 of the Path to Profitability Bootcamp where I teach you all my concepts and eventually my strategy so you can be profitable just like me and make money in the actual stock market, okay? What are fair value gaps, right? Fair value gaps are 3 candlestick pattern. We have a bullish example and a bearish example, right? Both have fair value gaps here. Why? 1, 2, 3, 3 candlestick pattern. The wicks, if there is a gap between these wicks, right? That is the fair value gap, right? Let's say the wicks overlap like this, there wouldn't be a fair value gap, right? Same thing with the bearish example. If they overlap, there wouldn't be a fair value gap. So let me just show you examples of fair value gaps, right? This is a perfect example. Fair value gap, right? 3 candlestick pattern. The wicks do not overlap. Price comes in, push higher, right? Let me show you an example where there is not a fair value gap, right? Right here, we have a 3 candlestick pattern. 1, 2, 3. But the wicks overlap, right? There would be a gap right here, but these wicks overlap each other, so there's no fair value gap. All right, it's pretty easy to tell where the fair value gaps are. If you can see, that's a fair value gap right there, right? All right, getting into why we use fair value gaps. Fair value gaps are very, very important, right? We use them as retracement tools. So if price retraces into a fair value gap, which it often does, then we take longs or shorts based on the direction of the trend. Okay, so we have a fair value gap, right? And as you can see, higher highs, higher lows from an uptrend, right? We already been over this. So if it comes back, it usually retraces into a fair value gap, right? Creating that low, that higher low based on the trend, right? Then it goes higher, right? We use it as a retracement tool to get a better entry. Same thing on the bearish example, taps into the fair value gap, pushes lower, lower lows, downtrend, right? So coming in to the second type of fair value gap that I would like you guys to know, it is a inverse fair value gap. This is probably one of the most important concepts besides liquidity that you need to have. You need to understand it. You need to, okay? So what is an inverse fair value gap? This is a fair value gap that gets disrespected by an opposing candle, right? So the candle body closes above the fair value gap. Usually, let's go back to that example that I had right here. Fair value gaps come down, tap into the fair value gap, but don't close below it with the candle body. They usually just wick into the fair value gap, and they should continue in the direction of the trend, right? Like this, we're in an uptrend. We come back down, tap into the fair value gap, and then we continue the trend, just like that. That's how a fair value gap should work, right? But if we disrespect the type of trend we're in, like if we disrespect a bearish fair value gap with a bullish candle close above the fair value gap, that could signal a direction switch in the trend, right? We could shift momentum and want to be targeting higher draws on liquidity, right? Opposing is bearish example, right? Let me just write these in. Bullish and bearish. By the way, the the candles don't matter. I just made these red so you would know it's a bullish example of an inverse, so on and so forth, right? So now that we know what an inverse fair value gap is and a fair value gap is, you can pair them together, okay? Right? So usually when price taps into a fair value gap, right? Right now we're on the 15-minute. There we go, right? Perfect. Right here. We have a bearish fair value gap right here, right? Bearish fair value gap. Let me just make it red so we can tell. Bearish fair value gap. Price comes up, taps in. What am I looking for? Confirmation that we're going to switch directions, right? We're not going to push higher, right? So this is where I use the inverse fair value gap. I take all of my trades off of inverse fair value gaps, so this is a must-have if you're going to learn my strategy, okay? So as we can see here, we push to this bearish fair value gap, create a bullish fair value gap on the manipulation leg, and if we're truly bearish, should we actually respect that fair value gap? No, I don't think we should, right? And just like that, we don't respect the fair value gap, and we continue lower. So where would my entry be? Right here. You put the stop loss at the high, and then you would target opposing draws on liquidity, right? Just like that, boom. It plays out for a 2.24 RR. And that's crazy money, right? So we can pair fair value gaps and inversion fair value gaps together. Once it taps into a fair value gap, we can look for an inversion fair value gap off of the manipulation leg in the opposite direction, right? That is how I base all my trades off of, right? Let's go into a bullish example, right? Let me see if I can find one really quickly. That would have been a good one. Here, right? You can also see that once price sweeps liquidity, right? What is a liquidity sweep, right? We look for confirmation after we sweep liquidity. That you can also pair them together in the opposite direction, right? We get an inversion fair value gap first, and then this creates a new fair value gap, right? Which we can then put a limit order, put our stop, put our target, and it will also hit, right? So you can pair them together during the specific order flow, right? To target opposing draws on liquidity. And that's how fair value gaps and inversion fair value gaps should be used together, okay? So this is a bullish example, right? Right here. Yeah, that's a good grasp. So that's gonna be the end. Let's get into your guys' homework. Hopefully you've been doing the homework. If you haven't, you're kind of cooked. Not gonna lie, you're kind of cooked. So homework: identify fair value gaps and inversion fair value gaps. Right. I'm also gonna put in here identify times where they were used together, right? Just like we went over. Times where they were used together, where an inversion fair value gap would wipe out a fair value gap, and then it would create a new fair value gap to tap into to then take longs or shorts, right? And then how fair value gaps form, and we can tap into them and then get an inversion out of it to then target opposing draws on liquidity, all right? So these are fair value gaps. Hope you guys enjoyed the video. Hopefully you got some knowledge in that brain of yours because you need it for the rest of this bootcamp. We need to remember these concepts if you're actually going to understand my strategy at the end of the bootcamp, all right? So yeah, remember to do the homework, all right? Stay tuned for tomorrow's video, all right? And yeah, I will see you guys in the next one. Peace out, boys.